The investment world, from the outside, seems filled with familiar concepts such as stocks, bonds, and stock market indices. However, when you dig deeper, you discover truths that most people do not know, facts that are almost hidden like a mystery. These insights reveal surprising details about how markets work, historical oddities, and investor behavior. They are not only fascinating but can also make you rethink your entire investment strategy. Below is a long overview compiled from some of the lesser-known corners of the investment universe. These insights come from scientific research and historical events, and many of them are the kind that make you say, wow. 1. Markets rarely reach new highs, yet they grow enormously over time. Consider the Dow Jones Industrial Average. Since 1916, this index has reached an all-time high on only about 5% of trading days. In other words, for 95% of the time, investors are somewhere below the peak, sometimes deep in the valleys. Despite this, the index has increased by nearly 300,000% over the same period, including dividends. This demonstrates the magic of compound growth. Daily gains may seem microscopic. Since 1970, the average daily increase has been about 3 basis points, 0.03%. But over time, these small increments accumulate into enormous wealth. This reality often misleads short-term investors. Markets rise on roughly 52% of trading days, but on negative days, they fall by an average of 0.76%. Yet despite these fluctuations, long-term growth has exceeded 3,000 times the original value. This supports the philosophy of look less, earn more. Constantly watching the market can push investors into unnecessary panic. For example, the Dow Jones historically spends about 20.6% of the time more than 40% below its peak, while only 18.4% of the time near all-time highs. This highlights one of the most powerful investment tools: patience. In fact, during the 2009 market bottom, long-term U.S. government bonds had outperformed stocks over the previous 40 years. Something that looks safe in the short term may turn out to be riskier in the long run. 2. A small number of stocks drive the entire market's returns. Looking at the history of the U.S. stock market from 1926 to 2016, nearly all market gains were generated by only about 4% of stocks. The remaining 96% either produced zero returns or lost money. This finding comes from research by Hendrik Bessembinder, and it shocks many investors because it challenges the common understanding of diversification. If your portfolio does not contain those superstar stocks, your returns may remain mediocre even if you invest across the market. This explains why dominant companies like Amazon or Tesla have such an outsized influence. Markets often rise on the shoulders of a few exceptional winners. Even more interesting, the distribution of returns does not follow a normal distribution, bell curve. Instead, it follows a power law distribution. That means gains are extremely uneven. Just a handful of extreme outliers can determine the entire market's performance. This also explains why about 90% of active fund managers fail to beat the market index. Predicting those few winning stocks in advance is almost like winning the lottery. Research also shows that individual investors tend to buy more during attention-grabbing events, such as major news headlines. Unfortunately, this often backfires because they end up buying during periods of hype. Even a positive earnings story in a local newspaper can increase trading volume in S&P 500 stocks. But this behavior is usually driven by emotion rather than rational analysis. 3. Alternative investments: cemetery plots and virtual land. If you move beyond traditional stocks and bonds, you will find some unusual investment opportunities. One little-known example is cemetery plots. As the population grows, demand for burial space increases, and prices can rise 5 to 10% annually. Similarly, virtual land in the metaverse, shares in sports teams, music catalogs, for example, the songs of Bob Dylan, parking spaces, and even luxury watches can act as alternative assets that hedge against inflation. Commodity investments can also be unusual. For instance, lean hog futures track the livestock industry and can be profitable under the right conditions, though such markets are rarely discussed in mainstream financial media. These investments are interesting because they are often illiquid and require specialized knowledge, yet their returns can sometimes exceed those of traditional markets. Technical analysis also contains lesser-known strengths. Tools like moving averages have been shown in some studies to outperform certain strategies. Research suggests that individual investors lose about 0.88% when prices reverse, highlighting the psychological importance of stop-loss orders and round numbers, such as $100. Conclusion. All of these insights demonstrate that investing is not just about numbers. It is a complex mix of psychology, history, probability, and patience. If you are not careful, the market can easily overwhelm you. But understanding these hidden dynamics can provide a real advantage. In the end, investing is a marathon, not a sprint, and perhaps the greatest secret of all is patience.